Hello, everybody. Good day. Welcome to Olga channel. Today, I want to talk about ratio analysis and their interpretations. All right, so my name is Cindy, and this is Olga channel. Please subscribe to the channel. After watching the video, please also like it, and please don't exit the video. Watch till the end, and God will surely bless you. All right, so I'll share my screen, then we'll get right into business. All right. So today we're talking about ratio analysis and what their interpretation. So most often it's very easy to calculate the ratios because they are just formulas, but sometimes you find it difficult to interpret them. Get it? We find it difficult to interpret them. So today I want to just share briefly on how to interpret our ratios. So we'll begin by calculating some ratios. I preferred using Excel because with Excel's automatic features, I'll be able to calculate the ratios fast, and then in few minutes be able to explain. With ratio interpretations, there's no fixed definition for interpreting what the ratio means, but instead, based on the formula for the particular ratios, based on the figures for the years given to you, then you can determine or interpret the ratios to best suit your need at that particular point in time. So here is a sample income statement that we'll be working with. Here is statement of financial position as well, because we need these two in calculating for ratios, because ratios would compare the financial statements to give us figures that would show us the financial or performance, or how these ratios, these statements relate to each other, to get a proper view of what the business operations. So our first ratio that we'll be calculating is operating profit margin. Then the formula for this ratio is what the operating profit over our total revenue. So whenever we talk about operating profit margin, or whenever you see the ratio with margin, its denominator is talking about what? Sales. So since this is just a formula work, let's just go straight into calculating. So just do is equal to, then we'll look for our operating profit in the income statement. Then here it is, and mind you, this is 2021, this is 2028. So we are starting from 2021, then we'll move to 2028. In order to use the Excel's function or the Excel's automatic way of calculating for us. So it's the operating profit, which is this, divided by this total sales, which is this. Then you press your enter, we get our figure. Then we drag it across the years. Then we get our respective figures. So this Excel's feature. So the first one was D9 over D4. The second, we realize it is what E9 over E4. So Excel is calculating it for us. Simple, simple, simple. Then we'll move on to the net profit margin. Okay, so the net profit margin, here there's margin, so it means that its denominator is what? Sales. And since it's talking about net profit, it means the last profit on the income statement. You see, on the income statement, we have the operating profit, pre-tax profit, and we have net profit. So the last profit on the income statement. So we'll go to our income statement, and that is this profit over the sales. They will press enter. They will move it across the years to get our figures. That's simple. That's what makes Excel interesting. Then move on to pre-tax profit margin. So since it's margin, it means its denominator is what? It's sales. And then it's a pre-tax. So the profits before we deducted our tax. That's what we are talking about. So bring our equal to sign. Then we'll move to our income statement. Then this is our profit before tax. That's pre-tax profit. We'll pick it, then we'll divide it by what? Sales, because we're talking about margin. They will enter and using the Excel's feature, let's move it across, and then it calculates for us. Then we'll move on to the return on assets. So we're talking about return, it's kind of like a gain. So here we are dealing with what net profit. When we talk about return on assets, if they don't ask you specifically for what operating return on assets, then you are using the what the large profit on the income statement. So yeah, just return. So it means you are using the net profit, right? So goes equal to, then move to net profit divided by, they will go towards our total assets. Then that can be found in the balance sheet, not the income statement. So here is our what's total assets. You have to make sure that you are using the right years. So the first one was 2021 in the income statement, then 2021 in the balance sheet. Then you enter. Then you calculate across the years. Let's see if Excel will do a good job here. So you see here it was D14 over what? K13. The second one is E14 over what? L13. So you see that Excel has done a very good job for us here. So we just move on to the next one. So this is just a formula work which everybody can do. So our focus will be on the interpretation of the ratios. So with the return on capital employed, so here with capital employed, it's asking us for what? The financing of the business. So what we will use is this side, we go to the balance sheet, not the income statement. So with the capital employed, it's what equity plus one non-current liability, because equity is like what the shareholders are bringing. That's what we're using it to what finance the business. And then the long-term liabilities, like going for a huge loan that you can what pay across a long period of time. You're not using the current liabilities because the current liabilities, they don't spread over long periods of time and it cannot be considered as what firm capital for the business. So with the capital employed is what equity plus capital plus what non-current liabilities. Some can also say total assets what minus current liability. So you see here, current liabilities is not supposed to be in the scene. And we know that asset is equal to what equity plus or liability. But here we are taking out the current liabilities. You get it? Okay. So I'll be using equity plus non-current liabilities. So our return is still our what net profit. So we'll move on to our income statement. We'll pick our net profit. Then we'll divide by the summation of what our equity and our long-term liability. So our equity is this plus our long-term liability or non-current liability, which is the long-term bank loan. So here we are not dealing with the current liabilities here. All right, so you press enter. So here, just bring the brackets. Excel will do it for you. Then you move it across the years. Then your calculation will be done. Then we'll move to the next ratio, which is return on what equity. So return on equity, return here is towards net profit. And then equity is what shareholders equity. So we just net profit. So equal to what our income statement, net profit over our equity, total equity. Then we'll move it across the years. Then our calculation will be done. Then we'll move on to the current ratio. So the current ratio is just the ratio of current assets to current liabilities. So here we are looking at the balance sheet. So we'll pick our total current assets, then we'll divide it by the total current liabilities to get our current ratio. So we'll move on to current assets, total current assets divided by what? Total current liabilities, which is here. Then we'll press enter. Then we'll use the Excel formula across the years. Then we see that Excel has calculated it for us. Then move on to quick ratio. So the quick ratio is talking about the most liquid what assets that the business has. And then that's the current assets excluding inventory, because we believe that inventory takes some time to be turned over and towards cash. So we take current asset, then we take out what our inventory, then we divide by current liabilities to get our quick ratio. So here, bring our bracket, then move to our balance sheet. Then balance sheet will take our total current liabilities minus what inventory. Then we'll divide total current liabilities minus our inventory. Then we divide by our total current liabilities, which is here. Then we press enter. We'll move it across. So let's see if Excel performed a good job. So in the second one, you see our minus sign is still here. So it's just Excel will just do a good job for you. So this is formula work, but it's good to go through. Then the cash ratio is also looking at using only cash to cater for our current liabilities. So those are only cash items in the balance sheet divided by our total current liabilities. So here we look at what cash and its what equivalent. So when we say cash and equivalent, example is, let's say, short-term securities, because you can easily turn that into cash, or let's say cash at bank. It's what equivalent to what the cash at hand. So we go to our balance sheet, then we pick our cash and cash and bank. Yes, they will divide by what? Add total current liabilities, which is here. They will press enter. They will move it to the side. So Excel has calculated it for us. Then we'll move on to debt to assets ratio. So with this one, it's debt and then assets. So we are looking at our total debt towards our total assets. So we are trying to talk about how the total debt we have has been able to help us to acquire certain assets in our business. You get it? So here is a balance sheet. So if you go to your balance sheet, you pick your total debt. So total debt here will be our um, long-term liabilities plus our current liabilities. Then we divide by our total assets because it was debt to asset ratio. Then you press enter. Then we move it across. Then we move to long-term debt to assets ratio. So this one is being specific to only long-term debt. So how our long-term debts or our long-term borrowing has contributed towards our total assets in the business. So we get our equal to, we go to the non-current liability side. That's the loan, it's only a bank loan, we'll pick that one. Then we divide by our total asset, which is this. Then we move it across. Then we'll go to our debt to equity ratio. So this one is mainly about is ratio to see or to know the capital structure of the business, whether it has a high debt coverage or a high equity coverage. So this one you pick your total debt to a total equity. So total debt divided by our total equity, and then total debt is so total debt, I'm coming. Total debt will go to our balance sheet. We pick our long-term debt and then our current liabilities. Then we divide by our total equity, which is this one. Then we get our debt to equity ratio. Then we'll move on to our financial leverage. So financial leverage ratio is just a ratio to know whether the business is into borrowing more debt to finance its assets or using more equity to finance its assets. So it's just knowing the amount of debt that the business borrows in its financing. Okay, so this one is the formula is total asset over what shareholders equity. So we'll move on to our balance sheets. We'll pick our total assets, then we'll divide by our total equity. Then we'll move it across the years to get. Then we'll move on to inventory turnover. So here when you see any turnover, the items turnover, now the item that is being turned over will become the denominator. So in this case, inventory is what being turned over. So that will become the denominator. And then here it's cost of goods sold divided by what inventory. We just want to know what the number of times we sell inventory. You get it? In the year relative to our cost of sales. So just to know whether we are overstocking our goods or we are translating them into cash. So here we use what cost of goods sold and not sales, because the reason I'm using cost of goods sales is inventory is like going to buy goods into the business, and it's about what purchases and those stuff. So it's related to what cost of goods sold. Get it? So we use cost of goods sold, which is in the income statement. That's cost of sales. Then since you are looking for ratios, but cost of sales is what negative, you just bring the negative side to make it positive so that our ratio will not be a negative figure, because we subtract it because it's a cost. But when you're preparing for what ratios, or we are working out for ratios, you have to take care of the negative so that you don't have a negative ratio to confuse ourselves. So it will be negative this number. Then we divide it by what? Average inventory. But here we are not giving opening inventory and closing inventory. We are just giving inventory in the balance sheet. So we just go straight and then take what inventory in the balance sheet. In the case where they would have given us opening inventory and closing inventory, you don't just take the closing inventory, but you take both the opening and closing and divide by 2 to get an average, and then use that to calculate for your inventory turnover. So here we'll pick our cost of goods sold, we'll negate it so that it become positive, then we divide by what our inventory. Then we get this. Then we move it across and calculate it. Then we'll move on to our receivable turnover. So here talking about receivable. So mean the receivable will become the denominator. So any turnover, the name of that turnover will become the denominator. So here it's going to be sales over what receivable. The reason why it's sales is we give people credit, or we let people buy on credit when we are selling, right? So it's not related to when you are buying goods, but it's related to when you are selling. That's why we use what sales. So here it will be our sales divided by what average receivables. But here we are not giving any opening receivable and closing receivable. It's only one receivable in the balance sheet, so we just use that one. So we'll go to the balance income statement, pick up our sales, then we divide by our pick up our sales, then we divide by our trade receivables, which is this one. Then we move it across the years. Then Excel will do the calculation. But when you're doing that manual, it's not going to be easy. To take time. All right, so total asset turnover. So here it's a turnover, means the total asset is going to be what the denominator, and then it's relating to sales, because from assets that we get our sales, the assets we have is what we use to generate the sales, right? Okay, so if you want to know the turnover, how much of sales we get from the what assets, so how we use our assets to get sales. So the sales will become the numerator, and then the total asset will become the denominator. So cap total assets from the balance sheet, then we divide, pick up our sales from the income statement, then we divide by what our total assets, because the turnover, so the assets will become what the denominator. Then we'll be done with the calculations of the various ratios. So now you come to interpret them. That's why Excel is very efficient. That's why I would have done it one by one manually. By the time I would have finished, I would have gotten tired. But it's all good. So with the operating profit margin, as I said earlier, is what you pick the operating profit divided by sales. So what does this tell us? So with interpretation of ratios, you don't need a specific English vocabulary. All you need to do is what understand the various items in the ratios. And then when you are doing comparison over the years, you know figures. If there's one and then now is 2, you know it has increased, right? If it was 2 and now it's 1, you know that it has what decreased. Just like your own personal money. If you have 5 cedi in your account and then now you check it's 4 cedi, it means that they've deducted your bank charges, right? So in the same way, just know the figures. Does it increase or decrease? And then know the ratios, the items in the ratios, right? So if for the operating profit margin, profit is something that would boost a business performance. So it means that with this, it means we have to be expecting a higher operating profit margin always, so that we know that we are improving. So you look at, is it a profit? Is it something that if it increases to affect the business or make the business better? So it's operating profit margin. If you're asked to explain maybe in 2018, so this one 2018. So let me format this whole figures to 2 decimal places to make it presentable. All right, okay, so this is better. So let's say now 2018 we got 0.31, and then you're asked to explain what it means. And then we know that the formula for operating profit margin is what? Operating profit over sales, right? And then when you look at the formulation or calculation of operating profit, is what? Our gross profit minus all other variable expenses like selling expense, advertising expenses, administrative expenses, depreciation, amortization, you get it. So if you want to explain this, what would you say? You say that, okay, so it's a profit that we are getting over our sales. So for every 1 cedi sale we make, how much profit do we make on it? So this will be my interpretation. So to you, what would you say it is? It's a profit and over sales. So it means what? How much profit are we generating from our sales after taking care of our variable costs, like the advertisements, the administrative, the depreciation, you get it. Or simply put, it's operating. So and it's profit. So the amount of profit you generate from sales after taking care of your operating expenses. Simple. So you see, calculating ratios is very easy, but then in academics or even in the real world, you don't your management or your bosses will not need the figures for anything. They need an interpretation. They need something to work on. You get it? So I'm not going to talk about everything here. I'll just pick some of them. So with the operating profit, just the profit that you generate from sales after taking care of your operating expenses. So if you are to compare them across the years, so in 2018 you made 0.31, in 2019 you made 0.21. So what is this telling you? So with this, I have to first check as the figure increased or decreased. So from 2018 to 2019 it has decreased. So it's telling us that from 2018 to 2019 there was the profit that the business was what has been generated from its sales has reduced from 0.31 to 0.21. That's it. Or if so, you can even find the difference and say it has reduced by this. So this is telling us that the business is making more operating expenses, because we know from a normal calculation that if you want to make profit, it's your sales minus your cost, right? So if you want your profit to be more, it means your cost must be low. So you can just deduce and say that. So from 2018 to 2019, the business has made more operating expenses, and thus it has reduced its operating profit. That's the profit it's what it has or it's made from the sales. You get it? Okay. So I'll also talk. So it just cuts across to the net profit. So it's also net profit over sales. So there's the actual profit. That's what let's say the business has generated from the sales. So this is the profit that they'll distribute to the shareholders. And so the how should I say it? The earnings of the business from the sales that generated. So it's profit and over sales. So pre-tax profit. So with the next one, you can say that the profit the business was generated from its sales after taking care of all expenses, tax-related issues, and then its financial obligations, because that's the last profit on the statement. So this one, you have to just know or understand the financial statements to be able to explain. Okay, so with the pre-tax profit, that's tax before profit before tax. So the profit the business was generated from its sales after or before taking care of its tax. You get. The return on assets. So with the return on assets, we are talking about profit over what? Assets. That's net profit over our total assets. So the amount or the was profits that the business what has made from using its asset. That's what I would say. Maybe that's not how you say, but it's about profit over assets. So the profit you've made from your using your assets, or for every one CD or for every one CD of what assets, how much profit what you make on that what asset, that value of assets, you get it. Then with the let's say current ratio, so it's what current assets over what current liabilities. So with this, you say that let's say this the current ratio. So I'll not touch on everything. So with the current ratio, we had 2.25, and then there was a liquidity ratio. I know that liquidity is about how the business is able to what, satisfy a short-term obligation as and when they are due. So the ability of the business to take care of its short-term liability. So if it may be someone the business is owing just comes right now, I want my money right now. How fast the business or how capable the business is to what, pay that person within that shortest possible time. So in this current ratio is using your entire current asset to what fund that short-term liability, and current liability short-term liability. That's its denominator, right? Okay, so if you had 2.25, what is it telling you as a business person, as a finance person? It's telling you that the business will be able to cover its current liabilities 2.25 times, or even if you round it to 1 decimal, 2.3 times. You get it? And it's very good because the ideal ratio is 2:1. You get it? So if it is 2.25:1, it means that the business can cover its short-term liabilities, its current liabilities, 2.3 times. So in 2019, we see that there was an increase. So what will you say? That's from 2019, the business was improved its what current assets, such that it is now able to cover its um, current liability 2.7 times. And that is an improvement, right? And it's good. Do you get it? So if someone comes to now that wants money, you can sell your current liability and get twice the amount that you need to cover for your current liabilities. You get it? So with a quick ratio, there's a limitation to the current ratio because there are certain assets that you can't turn them over quickly. So with the quick ratio addresses that. That's okay. So when we look at the um income statement, the asset side, inventory is not easy to turn over. So if let's say I'm a debtor and I'm a creditor and I come to a business and I'm coming for my money, you can't tell me that you can easily sell your goods within 5 minutes and then get your money back, because you are not the customers who are going to sell, yeah, who are going to buy the goods. Some people may not buy, people may not be interested in the goods at that shortest possible time, right? So the quick ratio is saying that let's subtract that inventory from what, the current asset, so that we get to have the most liquid what asset. So this one, you will say that the business, or yes, the business is able to what, cover its short-term liabilities what, once using its what, most liquid assets. You see, so it's not about a specific definition. No, how you understand it based on based on the formula of the what, the ratio, and then the figures. So in 2019 it increased so that the business will be able to cover its what, the business has improved its most liquid assets to an extent that to be able to cover its what, current liabilities 1.2 what times. And that is it. And everyone who hears this will understand. You get it. So let me take the cash ratio. So with the cash ratio, it's just using only the cash. So it's like if the creditor comes right now and said, I want the money now, how fast or how possible will it be for the business to get cash in its coffers and then pay the person at that point? So that's what the cash ratio is. So it's looking at how fast or faster the business could be in what satisfying its current liabilities, short-term obligation. So in 2018, you see that it was 0.6 times. That is, the business will not be able to what cover the current liabilities fully. You get it? It can't even cover it fully. So the business needs to what work on what ensuring that there is more cash on hand. In 2019, it improved the ratio by 0.04, but still it's not what enough to cover a short-term liability within the shortest possible time or when they are due. So with this business, even in 2020, it reduced drastically. 2021 so drastically. So I mean the business has to work or put in more effort in what maintaining more cash on hand. You get it? So that's what the cash ratio is. So the ratio is not about you knowing the figures, but you understanding what it means. So that as a finance person or even as an accountant, though you are not supposed to or you don't have any much obligation to be explaining ratios and there, but to you yourself, you're able to understand is the business doing well? What advice can I be even apply to you? Do you get it? So let me touch on the financial leverage. Okay, so with the financial leverage, it's what total assets over shareholders' equity. And as I said earlier, I was like, you see, to get so we know that total assets is equal to equity plus what debt. So in literal sense, equity plus liability, equity plus debt, right? So if let's say I have 30 assets and then my equity is 10, what is my debt? My debt is 20, right? So it means I have more debt. So what the financial leverage is trying to tell us that it's trying to let us know whether the business is highly leveraged, that it has more debt or it has what low debt. So if the equity in the ratio is low and then the asset is high, means the business would invest more debt into what buying its assets. So the business is highly leveraged and it can cause some risks at some point. So with this one, you can see that in 2018 it was 1.15. Then it means that the business was uses, let's say, how should I put it? The business has or finances, okay, let me use that way. The business finances its assets using 1.15 what debt. You get it? The business finances its assets by what using 1.15 debt. And then when you look at the 1.30, you see it's an increase. So this is telling the business that the business has what invested much into borrowing to finance its debt. So the higher the financial leverage, the higher the debt the business what takes to what cover its total assets. So that's what the financial leverage is. So it's more about knowing the amount of debt the business what takes from what its borrowers to finance its assets. You get it? So the last one I'll talk about is the inventory turnover. So the inventory turnover, as I said earlier, is about how many times within a period that a business is able to sell its inventory to to sell its inventory. So in 2018 it was 3.43, which is telling us that the business was able to sell its inventory 3.4 times within that period. In 2019, it increased to 4.3. That means the business has now improved its strategies to the point that it was able to sell its inventory 4.3 times. That's more times in a year. So that means the business is not overstocking its warehouse. It's not keeping more stock, and which is good for the business. So with this ratio, the higher, the better. You get it. So with the ratios, there's no specific explanation for the ratio, but it depends on you understanding the formula. So you have to first understand what the formula means. what items are in the formula, and how do those specific items affect what the balance sheet, affect the income statement, affect the firm itself. You get it? And then when you are checking across, yes, check as the number improve, as it reduce, it has improved. Then you will know, oh, okay, so with this ratio, if there is improvement, it's better. So this is how I explain it. If there is a reduction, it's not good. So this is how I'll explain it. You get it? So it's not about you calculating, but it's more of you what understanding and interpreting. Because this is the skill that any financial analyst should have, an accountant should have. You get it? All right. So let me touch on the last one, return on equity, because that one list is like is very important, because the goal of every business is to maximize shareholders' wealth, right? So it's the return on equity is talking about the amount of profit that each share of the business or what accumulates. So if there are 10 shares, how much would one share, how much profit would one share would have? That's something. So how much is one share, or what's the equivalent of one share in terms of the profits the business has made? So return on equity is what the amount of profits that shareholders would have shareholders are entitled to in the business after every other financial obligations have been taken care of. You get it? So as we already know, shareholders are the last people to receive their profits or something. Yes, profits when they are sharing. Yeah, so that's why we use the net profit. You get it? So with ratios, just understand each item in the ratio calculation. Know the figures. Has it increased or decreased? Is it an improvement, or it is a fallback or a shortfall for the business? Then you are good to go. So thank you very much for listening to this ratio analysis, and then how to interpret them on your own, because we all have our own ideas. Can't force someone to take your idea, but you can help someone to understand how to develop their own interpretation or ideas of something. All right. So thank you for watching. Please like the video. Please like the video. Please like the video. Share the video. Share the video and subscribe and subscribe. And God will surely bless you. Please take care. And I pray that you understand this visual analysis. God bless you. God bless you. God bless you. God bless you. Have a nice day. Stay blessed. Bye bye.